Welcome. Let's dive right into this comprehensive explainer where we're going to totally demystify market mechanics and actually track the footprints of institutional money. If you've ever looked at a chart and felt like the market was just this chaotic, unpredictable series of random spikes and drops, believe me, you are not alone. But what if I told you those moves aren't random at all? Today, we're stripping away all those lagging indicators and learning to read raw price action. We're going to see the market exactly how the big banks and hedge funds see it. So here's our roadmap for the masterclass. We're going from beginner supply and demand straight through intermediate smart money concepts and then hitting advanced topics like displacement, liquidity, and mitigation before wrapping it all up with the ultimate trade execution strategy. We are systematically adding layers here to really build out your trading intuition.
All right, let's kick things off with level 1, supply and demand. And look, before we get into complex algorithms, we have to grasp the fundamental economic force moving literally every market, that constant underlying tug of war between buyers and sellers.
These supply and demand zones are essentially the visible evidence of massive, unfilled institutional orders. Think about it. Massive entities like hedge funds can't just click a button to fill $1 billion order, right? They have to build their positions slowly over time. And when they do, they leave behind these little bases right before a massive rally or a really sharp drop. When price aggressively shoots away from these zones, it creates what we call an imbalance. It leaves behind this trail of unfilled orders that basically acts like a giant magnet for future price action.
Now, notice the shaded base area here in this rally base rally pattern, or RBR for short. It's an incredibly powerful continuation setup where the consolidation base marks a very clear demand zone in an ongoing uptrend. See how the price pushes up, kind of pauses to catch its breath, and then just explodes upward again? That base is a brief moment of equilibrium right before a massive institutional imbalance takes over. It's a literal footprint on the chart.
But here's the absolutely crucial detail, the 70-25 body-to-wick ratio rule. This is what perfectly separates real institutional rallies from just standard everyday market noise. Anybody can spot a big green candle, but true institutional footprints are highly specific. Your rally candles need to be fully committed, so at least 70% body. The base candles, though, represent a pause, so their bodies should be tiny, 25% or less, with long wicks that show that temporary consolidation. If you spot this right in the middle of a strong swing, you found a high probability continuation zone. And when volume spikes finally confirm that breakout from the base, you can confidently target your entry right at the 50% mark of that newly established demand zone when the price eventually retests it. Look at how beautifully the price returns to the exact midpoint of our base before launching higher again. This right here is where patience pays off. You don't want to chase the rally, you wait for the market to naturally come back to that institutional footprint.
Okay, foundation belt. Let's level up to intermediate smart money concepts. This is where we start using specific institutional vocabulary, and honestly, where we start getting really surgical with our chart analysis. So let's talk about the fair value gap, or FVG. Think of it as a pocket of imbalance. It's created when massive institutional volume enters the market so fast that it completely throws off the equilibrium. Modern markets are typically super efficient, right? But when a massive order hits, the price jumps so violently that it literally skips over certain price levels, leaving a gap between the wicks. The market absolutely hates this inefficiency, which is exactly why price so frequently acts like a magnet, getting pulled back to these FVGs to restore that balance. Then we have order blocks. These are the precise areas where institutional money breaks up hundreds of millions of dollars into smaller algorithmic increments. This causes tight consolidations right before massive impulsive moves. But listen, an order block isn't just any old candle. For it to be valid, it actually has to sweep liquidity, meaning it breaks a previous high or low to trap retail traders, and it absolutely must leave behind a fair value gap. Without that gap, you just don't have proof of an institutional imbalance. Now, smart money absolutely loves a bargain. So combining your order blocks with premium and discount zones ensures you aren't doing something crazy like buying high or selling low. It's just human nature for retail traders to want to buy out of FOMO when an asset is flying high up in the premium zone. But the institutional players, they wait. They pull out their Fibonacci retracement tools from swing low to swing high, and they only look to go long when the price drops below that 50% equilibrium line, right down into the discount zone. Moving right along to level 3, advanced displacement and liquidity. Knowing exactly when these massive institutional forces are stepping on the gas is how you tell the difference between a real move and a fake out. So you might be wondering what actually separates random everyday market chop from genuine institutional displacement. Well, retail volumes simply cannot produce the kind of clean, committed chart damage that we're looking for at this advanced stage. Normal price movement is kind of like a tug of war, where both sides have roughly equal strength, just bouncing back and forth with overlapping candles and long wicks. But displacement is literally when one side just drops the rope. It leaves a dominant, full-bodied candle with minimal wicks, basically announcing with absolute conviction that the big money has taken full control of the trend. When you see displacement, the logical question isn't just where is price going, it's why did it move that hard? And what does that tell me about where the smart money is positioned? That displacement is the mandatory ingredient that creates our fair value gaps. And that brings us to liquidity sweeps. Remember, institutions need massive retail liquidity to fill their giant orders. They actively engineer these sweeps to trigger your stop losses right before driving the price in their intended direction. If a big bank needs to buy a massive amount of an asset, they need sellers. And where's the biggest pool of willing sellers? Right below recent lows, where all the retail traders have parked their stop-loss orders. The institutions drive the price down, trigger those stops, absorb all that liquidity to fill their massive buy order, and then, boom, they reverse the market.
All right, level 4. Once that displacement happens, we need to know exactly how to handle the inevitable retracements back to our original order blocks. Let's look at mitigation versus breakers. See, not every block behaves the same way. If the price body closes past the block's extreme, your mitigation block has efficiently failed and it instantly transforms into a breaker block, completely shifting your directional bias. A mitigation block is basically an order block getting a second chance. The institutions didn't fill their entire order the first time, so they let the price retrace to fill the rest or mitigate it before continuing the trend. But if the market structure shifts and just plows right through that block with displacement, that's a breaker, and smart money is now heavily trading in the opposite direction. Okay, we've made it to the final stage, the Masterclass trade execution. Let's tie all of these concepts and footprints together into one elite, highly logical sequence. By combining higher time frame market structure, specific timing like the London or New York kill zones, and strict confirmation entries, you completely strip away the guesswork of traditional indicators. You aren't just blindly jumping into a trade because a moving average crossed over. No, you're waiting for the exact time of day when institutions are most active. You literally watch them sweep liquidity, wait for them to show their hand with aggressive displacement, and then calmly set your entry at the fair value gap they left behind in the discount zone with your stop safely beyond the order block. It's precise, it's disciplined, and most importantly, it's repeatable. So the big question is, are you going to keep trading the random noise, or are you ready to start hunting alongside the smart money? Now that you know how to spot the algorithmic footprints left behind by massive financial institutions, your entire perspective on the charts really should be fundamentally transformed. Sure, it takes time and practice to train your eyes to instantly see these order blocks, FVGs, and liquidity sweeps. But once you do, you stop being the liquidity and you start trading alongside it. The footprints are right there on every chart, every single day. The only question is, are you going to follow them?